Well, get started. Hello, and welcome to the Thriving in Volatile Markets webinar. As many of you know, I'm Brendan Sheehan of Waymark Wealth Management, and I'm excited that you're joining us to talk about this very timely topic. With the recent pandemic, we've seen extremely tumultuous times, especially in the February-March 2020 timeframe. And on top of that, of course, we're all dealing with the new normal and all the other adages that we talk about with living within this pandemic. And this workshop is designed to talk a little bit about the fight or flight feeling within all of us anytime the market drops, and how we can try to overcome that and think a little bit more rationally during times of stress. So our agenda for the day will be to first talk about volatility in the markets, then a little history lesson on the markets, some strategies to respond to volatility. We need to talk a little bit about the brain and what actually is happening in your brain during these stressful times. And then finally, how we actually here at Waymark plan for volatility. So let's get started. First, let's talk about volatility and why it exists and how it actually acts. So let's start a little bit of a fun thing here. If you were walking in the woods with your friend or spouse or whatever, and you encountered a bear, what would you do? Now, first, I think, like most people, you'd probably panic and run as fast as you possibly could go. But as you know, most wilderness survival guides would actually tell you to do something a lot different, which is stand your ground, play dead, and don't panic. And that's pretty much, and we'll talk about this in a moment when we talk about the brain, there is no difference with the way that your brain responds to a bear as it would a bear market. Now, what people talk about when they hear bear market, that pretty much means a negative market. A bull market is a positive market. And bottom line is, when you encounter a bear, that fear, that panic, that stress sets in. It's the same exact physiological response that we see when there's a bear market, like we saw, again, earlier this year in 2020. So what do we do about it? So the first thing is we have to acknowledge that investing is hard, and it also is very stressful. A lot of people say, money can't buy happiness, and money's not everything. But I think we have to appreciate the fact that money is a very important thing. It might not be everything, but it's very important. It gives us freedom, and it allows us to be able to do what we want, when we want, with the money that we actually have. So, it helps our families get from point A to point B. It puts people through college. It helps to educate people. So bottom line is, money is a means to an end. It might not be an end in and of itself, but it is a means to an end, and it's very important. So it's no surprise that when you lose a lot of money in a very short period of time, like a lot of people saw in that February-March timeframe, when the market dropped about 34% in 1 month, fastest on record, that people got very anxious, very nervous. And so with all that tied up, all that importance tied up in investing, why do we invest in the first place if all we're doing is pretty much giving ourselves the opportunity to be really stressed about things? So why do we do it? Ultimately, it all comes down to this. Our money that exists today has to grow with the cost of living. So cost of living adjustment or inflation, however you want to call it, bottom line is your investments, your retirement portfolio, your nest egg has to grow so that the lifestyle that you become accustomed to today can exist 20, 30, 40 years from today. And the only way that you do that is to use the stock market. It's the best tool that's out there to grow your money and to keep one step ahead of inflation and the cost of living. And that's pretty much why we're all here today. We invest our money to protect against inflation so our money doesn't lose value and potentially grow funds to help with future retirement or future goals. And we know the market's not going to go up all the time, but at the end of the day, it's still unnerving when the market has a big drop. So let's talk a little bit more about that. So volatility comes with the territory. At the end of the day, when people hear volatility, a lot of people just know that that's change. And when it comes to stock market investing, volatility there can be good volatility and there can be bad volatility. Good volatility is when you buy a stock at $5 and the next day it goes up to $10. But negative volatility is the exact opposite. You buy it for $10 and it drops to $5. Now, one of the psychological studies that are out there pretty much says that you are 2.5 times more upset and more emotionally charged when you have negative volatility than when you have positive volatility. So it's no surprise I don't get phone calls from clients when their stocks go up from $5 to $10, but I certainly get calls from clients when it drops from $10 to $5. So bottom line is we have to appreciate the fact that if you're going to, probably use this phrase throughout the presentation, if you're going to be in the kitchen and invest in the stock market, you have to take the heat, and volatility comes with the territory. So how do we accommodate that? Well, one very easy thing that most people do, especially with 401ks, is they invest a certain specific amount of money at specific times of the year. So when it comes to your 401k, if you get paid every 2 weeks, you may deposit a certain fixed amount every 2 weeks into the portfolio. And your mutual funds are going to be up or they're going to be down. So if they're up, then you're buying fewer shares. If they're down, you're going to be buying more shares. But in the end, it kind of evens out and you kind of eliminate that volatility, or at least mitigate it to a point. And so that's a concept called dollar cost averaging. I'll be honest, with a lot of my clients today, with the market hitting all-time record highs like we're seeing, a lot of clients who have money that's sitting on the sidelines right now and want to invest in the market, we've been counseling them to not just put all of that money in all at once today, but instead break it up into chunks. So for instance, I just met with a client a couple days ago. They wanted to invest $100,000 into a certain stock. We agreed that every 2 weeks for the next 8 weeks, they would actually invest $25,000 in, so that we're not dumping all that $100,000 in all in one fell swoop. Of course, just a big disclaimer here. When it comes to any of these strategies are not foolproof, and while historically they may have worked, there's no guarantee that they'll continue in the future. So let's keep going. Ultimately, when it comes to volatility, the markets prefer stability. And we have seen a lot of instability, obviously, throughout 2020 with, was there going to actually be a vaccine? Was there going to be a government bailout? Is there going to be a second government bailout? There's all this uncertainty, and then of course you have the election that's coming up that has, as we sit here today, it's only September. The election is, I think, 50 days from today, so there's a lot of uncertainty around that. Market does not like uncertainty, and when it does see uncertainty, you see these big swings up and big swings down. And what are the causes of volatility? Well, again, just coming back to what I just mentioned a moment ago, those are some of the things that are volatile this year in 2020. But all these things on the screen can cause volatility. And if you're investing in one single stock, there's all sorts of different things that can upset the apple cart. One example I always use is Martha Stewart. Several years ago, she was arrested. And the stock price of her Martha Stewart Omni company or something like that went down dramatically. Now, she was under house arrest. She was still able to pretty much manage her company, but she was on the headline of pretty much every paper because she got arrested. The stock price dropped dramatically. when in reality, it really shouldn't have. You know, the company was still operating as is, but that caused the stock price to drop dramatically. So all of these things can upset the market. And at the end of the day, you know, when it comes to volatility, I think it's as simple as this, is that people are unpredictable. That's why the stock market is unpredictable. So how do we handle it? Well, again, first, as we talked about before, volatility has occurred throughout history, and if you understand how markets have acted in the past, and you have to put the volatility into perspective. The markets have gotten very volatile with major upswings, major downswings, but in the end, historically, again, big disclaimer, historically, they've trended upwards. Secondly, it's really important to remember that volatility is a common part of long-term investing. And when volatility happens, like it did February, March, you have to appreciate the fact that it's expected. And it actually could be an opportunity for you if you can keep your wits about you. Third, you have to have a plan. You have to have a plan for both your investments, which I can help you out with, and how you're going to handle the volatility when it happens. You have to prepare for it, and when you see it in the market, remind yourself what that plan actually is and stick to the plan. And we'll talk about this. Is ultimately the theme of this webinar is that the emotional part of your brain will fire when confronted with something stressful, like a big market drop, a bear market. And what you need to train yourself to do is you need to train your brain to actually think more logically. And all these things that we'll talk about is to try to move the brain response from the back of your brain, your emotional side, to the front part of your brain. And finally, the fourth thing is to have a diversified strategy, which, like many financial advisors, I consistently champion is diversify, diversify, diversify. And we'll talk about that a little bit in a minute as well. So let's give you a little bit of a history lesson on the markets. Bottom line is most people know this, but again, it's worth repeating. What this is pretty much showing is how often over long periods of time the stock market has actually gone up. And what you see here is over any one period from 1928 to 2020, 70% of those years, the market has actually been positive. And then when you stretch it out to 3 years, 5 years, 10 years, 20 years, you can see that if you're a long-term investor and you just stay invested, you increase your historical chance that that your investment will keep going up. So appreciate the fact that there's short-term volatility, but if you're a long-term investor, it will, I can't say will, it has worked itself out in the past. And while this could always change in the future, it makes sense that it would continue. And ultimately, if you can appreciate this, that long-term it's going to appreciate. If you have a long-term horizon, then when the market takes a dip, that's an opportunity for you to potentially make some money during that time. This slide here just kind of underscores what I just said here. There have been a lot of really negative things in the news. You know, when I look at this, obviously the Lehman Brothers bankruptcy back in 2008 was a big deal. And it took a while for that to come back. But you know, we had a president that retired. We had presidents who were shot. We had near nuclear war with the Cuban Missile Crisis. There have been a lot of really crazy things that have happened in this country. And while the market has taken a dip and has had that volatility that we talked about, it always historically has come back. And while there's no guarantee that that will happen, there's a good indication that even our next thing, whatever it is, it's going to be something unprecedented, and I'm going to get phone calls from clients where they say, well, this time is different. I can point back to this slide and say, well, every single time one of these things happened, the response that I got from clients was, this time it will be different. And sure enough, in none of those cases had the market not recovered from its big drop. So this, I think, is the second most important slide that I want to show in this presentation. What this is pretty much saying is that when that bear market comes out, you get stressed, you get emotional, you get concerned that all this money that you invested in your nest egg could just lost a third in a very short period of time, like it did earlier this year, and it won't come back. And what this is pretty much saying is that over the 20-year period between 1990 and 2019, if you just stayed fully invested, you would have made a 7.7 average annual rate of return. If you missed one day of that, you lost or you gained half of that. And then as you go down the slope there, you can see that 2 years, 2 days, 3 days, 5 days, and 20 days, your rate of return could go down dramatically. It's just remarkable when you look at this. Missing just the 5 best days over the past 20 years would have reduced your investment returns by 2/3. That's just crazy. So again, it makes the very strong case that, at least historically speaking, staying fully invested in the market is your best bet, even during times when it seems like all hope is lost and we have very unprecedented events happening in the world. This is, I would say, 2B. So this is also a very, very important slide here, because this is the comment that I typically get. And again, I just got this 5-6 months ago when the market had a big drop. Well, I'm very nervous about the market. I don't know when there's going to be a vaccine. I don't know what the government is going to do in response to it. I don't know when I'm going to actually be able to go out to a restaurant. I'm just going to pull all my money, put it on the sidelines, turn it into cash, and wait till it all settles out. The risk with that strategy is what you see right here. Typically, historically, whenever there's a big drop in the market, it's followed up by a big gain in a very short period of time. And very few clients, I would say 99% of clients, if they pull all their money out of the market and go into cash, they're not going to, within 2 weeks, put it back into the market. And that's pretty much what's being shown here. October 2008, the largest loss during the 2008 crisis was almost a 9%, or a little bit more than a 9% drop. And within 2 weeks, it gained half of that back by going 10.79 up. Bottom line is, again, you don't know when the sentiment of investors is going to change, and it can change on a dime. And most clients, and I'll show you this in a moment, most clients that try to time the market fail, and that's pretty much why this slide here pretty much shows why. So now that you know how markets tend to react and you know volatility is going to happen, how do we respond to it? So this, I would say, is the #1 slide of the entire presentation. This is a company called Dalbar. You see it at the bottom there in the disclaimer. The Dalbar has pretty much kept this study going for many, many years. I've been following this for about 10 years, and consistently this result has shown. And what it's pretty much saying is that the stock market averages 9 to 10%. The average investor, on the other hand, makes 5 to 6%. And why is that? We all know. Ultimately, investors are terrible at timing the market. They'll start investing in the market when the market is at all-time highs and everyone, their friends, family, neighbors are making money in it. And they say, I'm going to put money into the market when it's really expensive. And then on the flip side, they get spooked when the market goes down and they sell at the absolute low. And again, just going back to keeping your emotions in check and staying the course typically works out, as this slide is actually showing. So what do? The moral of the story is have a plan, stick to it, and stay invested to weather the volatility. And it's very hard to do, and we'll see why in a moment, because ultimately we're hardwired to respond to volatility in a very emotional way. But bottom line is what my job is, and I'd say probably 90% of my job is to try to help clients to from reacting emotionally to reacting a lot more rationally when things happen with the market. So now that we've had our history lesson, let's look at science to see how we all react when money's involved. So most of us think, when they think money, they think numbers. So it should be very logical, right? But as we talked about, money is a very, very important thing. And so ultimately what happens is some of the most basic parts of our brain, the amygdala, which governs the fight or flight response. It's also called the lizard brain, triggers. And there's no way to suppress that. That is just, since caveman time, that's how we've actually stayed alive. If we saw a polar bear, we would run. And that fight or flight kicks in, and the faster it kicked in, the more likely we were to survive. So it's a very, very strong response that triggers immediately. And if we look at our ancestors, the ones that had the most developed amygdalas were more likely to survive, very Darwin-esque, in that response. And so we have to appreciate the fact that when stress happens, when we see this bear market that we were talking about, your emotional part of your brain will trigger. There's no way around that. That's just the way that we as humans are hardwired. So if we look at our little lizard here, it works quickly, and it works like this. And so your initial response, stress, I have to do something. And in a lot of cases, what you will do when you lose money is driven by emotion. You'll do anything to avoid the loss, even if it's not rational. Even if you know everything that we've talked about up to this point, know all those slides about how the market responds and staying invested long term, that fight or flight instinct kicks in, and there's no way around it. But the good news is that we actually can train our brain. And so if we look at the next slide here, when you train your brain and you can appreciate the fact that there is this kind of cyclical way of how your brain responds, you can see it here in this wave that we're looking at here. And I would argue that, if you were really honest with yourself, a lot of you have gone through these waves of investing. And what you see is when you're optimistic and when you're, elated, even Alan Greenspan back in 1996, he termed it irrational exuberance. So he was even acknowledging it's irrational, emotional exuberance. And that's what you see there, at the elated part. And that's one of the worst times to invest, is when everyone else seems to be making money and money and money, and you invest your money when the market is very expensive. That's some of the most dangerous time to do so. And then as the market starts going down, you start rationalizing with yourself until you get to a point where it just seems so desperate, and you become literally frightened that you actually sell. And that's what causes the big difference between what the stock market does and how the average investor actually performs. So how do we train it? Ultimately we have to try to engage the prefrontal cortex, which is the rational part of the brain. And this is a concept called behavioral finance. And we talk about this a lot here at Waymark, is that there's traditional financial planning. That's the black and white stuff. But then there's the behavioral finance, which is appreciating the fact that people respond emotionally when it comes to money. And our job is to continuously, almost like a personal trainer, continue to develop this part of your brain so that when the stress comes, you try to respond as rationally as possible. And so it all comes down to trying to break habits and create new habits. And so what we do here at Waymark is consistently, and I guess consistent is the right way to think about it, is that we're constantly meeting with clients and kind of reminding them why they're investing this money, why all this volatility is normal, and again, just like a muscle, continue to grow that prefrontal cortex response so that that takes priority over the amygdala, which is the thing that's going to cause you to act emotionally to these things. So how do we do it? So it all comes down to shifting from right brain, which is very emotional, to left brain. And some of these left brain activities are planning, recognizing, empower, and sticking. So ultimately, you have to have a plan and always default back to that plan when that emotional side hits. And so if you know your emotional brain is going to drive you to sell out of something, you acknowledge it and decide ahead of the time what to do. And so, little secret, you know, there's one client that hopefully he won't get mad at me for mentioning him, but he got very nervous in February and March and said, I want to sell out of my investment portfolio. And he had about $100,000 with us. And he said he wanted to go all cash. And I said, great. And I'll call him Peter. I said, great, Peter, you know, we can do that, but when are we getting it back? When are we going to get back in? I said, at what point does the stock market have to go down in order for you to get back in? What I was trying to do is I was trying to move him from this emotional response of sell everything, run, just like the bear response, to let's have a plan. If we're going to get out, let's have a very distinct black and white plan to do it. And ultimately, he never sold out because, you know, again, I was able to move him from the emotional to a more rational way of thinking about it. And of course, you know, luckily the market has come back and he did well to just sit tight and not make any changes. But it's hard to do. It goes against our ancient wiring. And the way we have to do this is you have to have an accountability partner who will empower you to help stick to that strategy. So now that you know how the markets react and how your brain reacts to the market response, let's talk a little bit about how we help plan ahead so we can train you to stay the course. So again, I think I've said this probably 3 times at this point. What our job is as a personal trainer is to try to build that prefrontal cortex rational side of looking at investments. And so we ask you to articulate your goals. And we talk about timelines and when you actually are going to when you're going to actually need to access your money. And then we look at risk tolerance. And risk tolerance is an important thing. That's pretty much identifying how much heat you can take while you're in the kitchen. And so we ask you to articulate that stuff, write it down, so that when the inevitable market volatility and the emotional responses kick in, then we can go back to those things and just remind you, hey, listen, I'll pick on Peter again. Peter, you know, we're not going to be needing this money anytime soon, so why do we need to sell out of it? You know, and remind, you know, these are the goals. You have a goal to, I don't know, pay for your daughter's wedding. That wedding isn't for 5 years. She's not even engaged yet. You know, so we don't need to take any dramatic steps. And we know rationally that staying invested in the market is the right thing to do. So having that accountability partner is absolutely key. And so again, looking at the risk tolerance, we ask every client to go through a risk tolerance profile so that we know that we're not going to put them into a portfolio today that when stress happens and the market really takes a big, you know, actually hits that portfolio really hard, that they're going to have so much heat that they get out of the kitchen. So you want to actually, as an advisor, we want to be able to make sure that we structure a portfolio that a client can live with during times of stress. And the key part of that is actually making sure that we quantify what a client's risk tolerance is. And we score it on a scale of 0 to 100, 0 being very, very conservative, 100 being aggressive. And if they come back as aggressive, then we look at stuff that has the opportunity to make lots of money, but also the opportunity to lose a lot of money. But over time, that should do pretty well, as we talked about earlier. And vice versa. If the client's conservative, we're going to create a portfolio that's not going to see these big ups and big downs, so that when that stress hits, yes, their portfolio might go down, but it's not going to go down to a level that they have that overwhelming ancient response that the amygdala would actually create for them. diversify. So again, very, very common thing with most advisors is that we want to make sure that we have different investments from different asset classes that don't perform the same during certain market environments. For example, stocks tend to do well during times of growth, and bonds do okay during those times. But on the flip side, when the market has a big drop, bonds are usually the things that hold their value, whereas the stocks can take a big hit. So, putting them all in the same portfolio helps to normalize that risk, and again, try to make it so that the emotional side doesn't take over the rational side. And again, no guarantee with any of this stuff. There are times when things that shouldn't work hand in hand with one another will actually both drop at the same time. But historically speaking, you can actually quantify how correlated different asset classes are to one another and try to mix and match them, and that's pretty much what we do with every client's portfolio. So ultimately, we build this strategy, and then once that strategy is put in place, we revisit it over and over and over again. For our clients, we look at these things could be every 2 months, 3 months, 6 months, but we're constantly reviewing this and making sure that, one, whatever strategy that we put in place tracks to a benchmark that we all agree to. Two, that it's going to help achieve the goals that you're looking to achieve. And then three, weather a variety of market environments. And so, if we don't, if there's a investment that we've recommended that isn't doing what it's supposed to do during the time that we expected it to perform in a certain way, that's when we make adjustments to a client's portfolio. And that's pretty much what this slide is pretty much saying, is that is it tracking to the benchmark, is it tracking to goals? And the other big thing here on this slide is your goals may change. So yes, the market and things may change, but what if there's a job change? What if there's a birth of a child? What if there's a death in the family? Things change all the time, and so financial planning is never a static thing. It's constantly changing, and we need to adjust sometimes the portfolio to accommodate that. So that's pretty much it. Wanted to talk a lot about this stuff, and ultimately the last few months have been very challenging for all of us. The future is not certain, but we're all in this together. I'm here to help out my clients, and hopefully anyone who's on this that's not a client, they'll give us a chance to help them through these challenging times. But it's really these times, I half jokingly talk to, people ask me today, how's business going for you? And I say, it's actually doing really well. And the reason is that, ultimately people seek out financial planners. Warren Buffett has a very famous quote. He says, when people get greedy, he gets fearful, and when people get fearful, he gets greedy. And I feel like in our business, when people are either fearful or greedy, they come to see me. And that's what we're here to do, is to help clients get through some of these tough times. So my job is to help create that strategy. Again, continue to coach you so that we can build a strategy that we always revisit whenever there are those inevitable emotional times in the market, and work through those goals and keep you on track. And ultimately it's to achieve a bigger thing. It's not just to make big piles of money, but it's to achieve certain goals. And so that's what we're here to do. So that's pretty much it. Those are all my prepared comments. What I will do here is take a sip of water, since I've been talking for about 30 minutes or so, 35 minutes it looks like, and see if there are any questions that come in. So I'll